Welcome everyone to another episode of Wolf Street. For those of you that don't know, my name is Wolf, and for those of you that do, thanks for checking me out again. As always, you can check me out on all social media platforms at EveryTimeICash. That's at EveryTimeICash. No funny characters, spaces, handles, periods, etc. Also, I'm not famous or popular or anything like that, but it has come to my attention that some people act as though they are me to solicit you for money, or some people for money. So if you ever get a message from someone pretending to be me, asking you for money or asking you to join something, it's not me. I'm not going to slide into your DMs. Also, while we're on the topic of DMs, feel free to reach out to me on my website, everytimeicash.com/contact. If you have any ideas, opinions, questions, etc., I could be reached there. This video, like all videos, is for informational, educational, and entertainment, emphasis on entertainment purposes only. It's not to be substituted or used as financial advice. If you're looking for financial advice, please seek the help of a financial professional. Reach out to some qualified individuals to build a strategy that suits your needs. Look, I'm just a dude sitting in his pool house making videos on the internet. I'm not qualified to tell you what to do with your money. It's just me wanting to document what I see and have a little fun. So don't be the guy that takes this as financial advice and then gets divorced on the back end of it. Now that diatribe's over, this is the first video of 2022. So Happy New Year, Merry belated Christmas, and Happy Valentine's Day here soon. At the end of the year, I thought that things were kind of self-explanatory, and then I wanted to see what would happen on the back of the Fed before I, ranted about it and gave my opinions. I'm going to try to make this video quick, and I'm going to try to make these videos more frequent, but wanted to say Happy New Year, and I hope you guys have been faring well and all that other good stuff. So now that I've wasted 2 minutes of your time, let's just jump right into it. I want to start by saying that on the way up, we were very cognizant and we were very, honest with ourselves, and I use the word honest here loosely, about the Fed having our back. And the whole way up, all you heard was people tell you that you've got a backstop, the Fed's got our back, Fed's got our back, Fed's got our back. So if we're going to believe things on the way up, we have to believe them on the way down. And our man, J-Pow over here, has become public enemy number one, as the Fed has kind of eased off of, and I use the word ease here for fun, their dovish stance, and they've become a little bit more hawkish. So we're in this weird moment right now where we have a lack of liquidity and participation on a relative basis. In some of the momentum names, we have dispersion taking place in the market itself, and again, with some of our momentum names, and we have a lot of bifurcation, a lot of snapbacks, both up and down, and a lot of lack of leadership. Now, on the way up, we were very adamant that the Fed will save everything. The Fed's not going to do anything to stop the rally, and that appears to no longer be the case. So we have to treat things that way. So if you take a look at what's happened, you get and take a look at the Fed's stance and what's going on. You get sell-offs in growth. You get sell-offs in risk assets, long duration stuff, tech, etc. Those get murdered, and then you get the value stocks and things that are rate sensitive that perform. This is not like a coincidence. This is a function of an input-output function. Fed gets more hawkish. They got to raise. They're going to raise rates, and people act accordingly. Now, in the moment, what that does is it creates a uncertainty, and it creates a lack of clarity for the markets. This is for a lot of different reasons, but fundamentally speaking, one of the primary reasons is that our stalwarts, easy for me to say, and our leaders for the last decade are no longer acting the way that it did for the last decade. So for 10 years, we had this blind, with a couple of stops in between, like 2011, 2014, but you get these blind by the dip moments, and that's not working anymore. And there's a couple of reasons why, but the primary reason is the Fed's changed its course, and people have to adapt to it. So it's very important, no matter what kind of trader you are, investor, whatever. It's really important to know, levels around what it is that you're trading. I don't care if you're trading Bitcoin. I don't care if you're trading corn. I don't care if you're trading pogs. I don't give a shit what you're trading. You have to know, pricing levels for what it is that you're buying or what it is that you're selling. So it's important to start every day, week, whatever. It doesn't matter what kind of trader you are, with some idea of where you're at and where you can possibly go. So for me and for the subscribers, etc., every day we start off with some form of this collage that's on our screen right here, some form of this, right? So we want to get a snapshot of what markets are doing, where we're at, technically, where we're at, fundamentally, if things have changed, what's outperforming, what's underperforming, etc. So I like to start every day with a quick little view, quick little collage of that. And also, I like to know what my levels are for the day. So you could do this yourself. You could do it in Excel, or you could subscribe to a litany of services that'll do this for you and just kind of provide that data. So it's totally up to you. It's totally independent of, of whatever type of trading that you do. It's all the same at the end of the day. You have to know where your levels are: critical support, critical resistance, etc. Right? So with that being said, we can just pull up the S&P 500 chart, right? First things first, we had support in July at this 4260 level. Then again, we had support in October, 4260, and then recently we just tapped it again. So the first thing that I want to point out is, we had support in the summer. We rallied, we failed, we made a new high, and then we failed again. So currently, the setup is that we could possibly roll over here at the 100-day, which is kind of like in line with our prior high, and on the back of this rollover, create this giant head and shoulder topping pattern in the market, right? So this is an outcome that could possibly happen, or something else could happen and this outcome becomes invalidated. So for me, I'm a technical trader, so this is something that I wanted to highlight, and it's something that I looked for potentially when we were making these lows back in late January. The other instance that you want to take part in, or take note of, is just how violent some of these moves are, right? So we basically moved 7.5% in a matter of 4 sessions, from the lows to the highs. These are really violent moves, and I want you to flag that and keep that in the back of your head, because it's something we're going to touch on a little bit later. But essentially, you want to make a point of reference in the back of your mind, just how fast and how violent some of these moves are. So if we move on from the S&P to the Nasdaq itself, you've got something similar, but in this case you had a break of the October and summer lows that we had, and you actually made new relative lows, and had a bottom basically at 13.6 and change, or 13.7 and change. Now we've again done the same thing though. We've rallied off the lows, and we rallied back to the 200, 150-day in between them, and we found sellers and selling there. Now the Nasdaq's interesting because of just it's a microcosm of a lot of the things that have happened in the last decade or so. And what I mean by that is we had a lot of the generals that have led us here begin to act weak and effectively break in some cases recently. First and foremost, fresh to mind is Facebook. Facebook dropped 30% basically in 3 days, right? We're pressing up against a prior high. Everybody and their brother had this long-term Facebook trend, channel, whatever, however they drew it, doesn't matter. We effectively broke this trend, and this just illustrates just how fast and how violent some of these breaks actually happen. Now, on the back of this, you'd want to keep in the back of your mind that Facebook's trading basically at a prior high, and on the back of sell-offs like this, generally someone may step in and support the stock. So that's something to keep in mind. Another one is Amazon, right? So Amazon had the opposite effect. Amazon had a double top, started in last summer and then confirmed late November here. Double top, sold off, came down to basically staring into the abyss, which was the breakout point from July of 2020, and then shocked people, quote unquote, with their earnings, and we had a reflex rally back above. Now, the interesting thing when you back out on Amazon, if we just back out here, I didn't see this one go as viral as the Facebook one, but essentially, Amazon was in this long-term uptrend from 2009, and prior to earnings, we'd already snapped it. So if I could just pull up this, we snapped it. So essentially, we snapped. We stared into the abyss, and then we rallied back to more of our supply zone here, and it appears that we're starting to roll back over against the 50-day. So this is important. It's important to mark these things, and it's important to take note of these things. Tesla, same thing. We had a double top, sold off to the 200-day on the back of earnings, found support, rallied, and then we're stalling out near the 20-day. So it's really important to note these things and to see where these things are going. And if you just go through the cycle real quick, let's just do Apple real quick. Apple's the one that is acting a little bit independent of some of these names, but same kind of concept. Sell off, 100-day, 150-day holds, upside surprise, rally, come back to our breakdown point, and then run out of steam. And I bring this up because if we just take a look at where we were last year, and this is a little bit old, so I don't know if I edited the numbers in the slide to reflect the accurate market cap, but I don't know how accurate the 25%. It might be more, it might be less, so forgive me for that. But essentially, we had nearly $10 trillion of market cap, basically buoy the market for the better part of 2 to 5 years. So anytime you'd have these massive sell-offs, it'd be those instances where you look at your portfolio and you'd be like, man, how are 7 or 8 of these names that I have down, but my portfolio or the market itself is up, right? And it would be because you'd have Apple, you'd have Google, you'd have Amazon, you'd have Tesla carry the load, and then you'd have a lot of the names underneath kind of not perform, right? And so it's important to note this, because on the way down, these things will start to act as a headwind. So on the way up, they would buoy you and they'd carry us and offset a lot of the losses. On the way down, they do the opposite. So in instances where we're going to start seeing some selling, so you'll see some. So for example, you saw Facebook, right? A 30% move in a matter of days. Well, that really breaks a lot of the upside that you might get from smaller names. The other thing that it does is it presents opportunities. So in the case of Facebook, for example, it takes out a lot of other names that may trade in unison, because people will just throw the baby out with the bathwater. And that may present opportunities if some of these companies that get sold off with Facebook, so in this case, Snapchat, do in fact surprise, because they're not actually that related in terms of the kind of customer that they're after, right? So Facebook was really impacted by TikTok, Amazon not so much, or I don't know why I keep saying Amazon, Snapchat not so much. And so you get these opportunities where you get, in this case, I think it was a 50% move in a day, basically. So this is the type of market that we're in. These are some of the conditions that we have, and it's important to take note of some of these conditions. And these conditions create uncertainty. Outside of some of this uncertainty that comes from price action, we actually have an economic uncertainty now, and a fiscal uncertainty as well. So on the economic side, we're dealing and we're battling with the transition from a goods economy to a services economy. So if you just think about it from the last two years perspective, we were in lockdown. People needed to buy a bunch of crap. They needed to buy shit. They needed to buy their Peloton. Got to buy 7 monitors. Got to buy a laptop. Got to buy a car. Got to do all this stuff. Got to get a new house because I need more space for my work from home. You got to do all this stuff. You have to buy all this stuff in order to facilitate your new lifestyle, right? And we're transitioning out of that now, as things kind of go back to normal. And what we're gonna see, hopefully, knock wood, over time is, excuse me, my dog is barking. Over time, what you're gonna see is you're gonna see people transition from that goods economy to a services economy and experiences economy, and you're gonna see individuals try to go from buying stuff. Sorry, guys, my dog's just going nuts. You're gonna see people buying stuff and go to trying to take trips or having experiences or whatnot, right? And so as this happens, a lot of these names that have benefited from the goods being bought are going to face tougher comps. So in the case of Amazon, for example, Nike, Lulu, etc. And so this is going to create a little bit of a cloud, as some of these names have larger market caps than others, and it'll create a little bit of a cloud for investors as they try to figure out whether or not we're reopening, whether or not we're good, whether or not we're not, and move from there. So on the back of that as well, we're also battling a persistent level of inflation, and we have this optimism that inflation is going to soften and come down on the horizon. So what that just says is that inflation has lasted longer than a lot of people may have predicted. And I use the word a lot of people here in quotation marks because anyone with two brain cells that thought about it pragmatically without their positions on the table, or like not wanting to be the bad guy, and was honest about it, understood that we were going to have inflation. It's just a basic input output function, right? So, but that being said, this inflation has been stickier than quote unquote economists have said, and it's this function of, we know inflation is going to soften at some point because some of these log jams that are creating supply chain restrictions, and some of these COVID related things. So like in China, they lock down, don't lock down, etc., day in and day out. Some of these things are going to come off over time, and so inflation should, in theory, come down a little bit over time. But as it persists, it creates more stickiness to this inflation. It creates more headwinds, and it could be a little bit more of a situation where things kind of take a little bit longer than they should. A good example of this is the semiconductors, right? So we need semiconductors in order to really push forward economically, and when there's a pent up demand for it. But in general, they can't be manufactured fast enough. They can't get over here fast enough, and it's really slowing things down. So you get this push pull between the demand side of things and then the actual persistent economic headwinds that last here, right? Lastly, we have a hawkish Fed, and we're trying to price that in. So that actually could be a positive, and I'll talk about that on the next slide. But currently, the market goes back and forth as different Fed members come out and start talking. So this guy's is hawkish, this gal is dovish, and this guy doesn't know what the fuck he's talking about, right? So like every other day, these guys are talking, these girls are talking, and it creates a little bit of confusion. And then the market's trying to price this in while trying to battle other situations that may or may not be going on. The last one we went over a little bit, but we have dispersions and fractures of old themes that are taking place, and these are like 10 years worth of trades that are being unwound. And forgive me, it's 5 to 10 years if you want to be specific. But think cloud names, think it doesn't matter what your favorite acronym is, the FMAGA complex, the FANG trade, it doesn't matter. The Fat Mang, it really doesn't matter. These trades have been blind by the dip for the better part of a decade, and as rates begin to normalize or the Fed starts raising rates, a lot of these blind buy the dip strategies become unwound. And it's important for a couple of reasons, not least of which a lot of these names are owned by everybody. So if I own, 2% of Google in my portfolio and 3% of Facebook, and on the one hand, I see, Facebook gets slaughtered, and on the other hand, I see Google run up, I have to rebalance that, right? And as you have more and more of these names take place in that fashion, and some go up and a lot of them go down, you're going to see that displacement, or that fracture continue to happen that way. So these are just some of the things that are kind of like holding us back on that front. And then lastly, on that front, you're going to see names that just kind of accelerated too far too fast that need to reset. And now those names have a large weighting, and that large weight in whatever portfolio or index it's in has to affect the other components of that portfolio or index. So in this case, just think Tesla, right? So Tesla ran from, whatever it was, $80 billion to, north of $1 trillion. And, maybe Tesla does stuff that materializes its market cap. But most likely, it probably got a pull forward, went too far too fast, and needs a reset. And in an instance like that, a lot of that froth has to come off, and a lot of people will continue to battle on the way down. And I don't know where it stops. No one knows where it stops. But as these things come down, all of the names and components that are associated with Tesla will become impacted. And it will create this fracture in the marketplace, as like Tesla going down 2% has a larger impact than like 30 small cap stocks going up 5%, for example. Just throwing out random numbers, so it's not like the actual math might not be accurate, but I'm just giving a hyperbolic example. But this brings me to my next point, right? The good news about all this is that as things start to get priced in, any sort of surprise or change from what people are expecting becomes a positive. So currently the good news is the odds are that the Fed is going to hike at least 4 times, right? If people are expecting the Fed to hike at least 4 times, as the Fed changes any of their opinions on what it is that they're doing. So if we expect the Fed's going to hike 4 or 5 times, and the Fed decides to hike 3 times instead of 4, that becomes innately bullish. It's a bullish thing because people are positioned too far to one side and not to the other. And this is a good situation because this could be a situation where the Fed's actual actions don't align with people's most negative, pessimistic thoughts that they might have. And so this is an important thing and an important anecdote to keep at the back of our mind, because as the Fed tells you that they're going to be hawkish, it's a bad thing. That's how the market's perceiving it, at least, right? But if at all they soften, and this happened in, I think, 2011, 2014, it creates a reflex rally because people need to now go, well, wait a minute, maybe we were too bearish, maybe we were too negative. We need to facilitate and accommodate a change that we just saw here, right? So that's a very important thing to keep in the back of our mind, so that we don't get too high and too low. And this is important for the last slide that I'm going to leave with, right? And so the goal this year for me, and what I was telling subscribers and anybody that I talk to, the goal is to be defensive and to be as the wise Marshawn Lynch said, protect your chickens. So the goal is to protect your chicken, right? So the goal is to protect your money. It's to make sure that you don't lose your money. And what you don't want to do is you don't want to press long into major rallies, and you don't want to press short into major sell-offs. You kind of want to bat the middle. You want, if things start to get too stretched to the upside, you want to keep that in the back of your mind, kind of ease up. If things get too stretched to the downside, you want to do the same. You want to ease and keep that in the back of your mind. If you wanted to get into a position, so like let's just use Facebook for example. Let's say you've been eyeing Facebook for the last 5, 6, 7 months. I need a time to start to enter. Well, sell-offs like this generally at some point. So I'm not saying here, but at some point we'll find buyers, right? So if that's a position that I wanted to open, I'd want to at least explore it on the back of a major sell-off like that for me, right? And the opposite's true. So if I have a position and it's long in the tooth, I don't want to overstay my welcome. I want to kind of trade around this stuff, and I want to expect that some of these moves will be very violent, as we saw earlier on in some of the charts that we went over. You get 7.5% move in the index in like 3 days. That's a huge move. You get a 30% sell off in 3 days. That's a huge move. So this speaks to not wanting to overstay your welcome in some of these names and some of these ideas and some of these positions. So with that, I want to say thanks for your time. Thanks for sticking with me. Sorry about my dog. If you have any questions, please reach out to me at EveryTimeICash. If you have any direct questions that you don't want to reach out to me on social, it's everytimeicash.com/contact. Thanks again for your time. Please hit the like button. Please comment. Leave me some feedback if you'd like. And I'd appreciate if you gave me a subscribe. It'll incentivize me to stay on this a little bit more. So with that, please stay safe, stay profitable, and as always, stay locked in.